Most people think wealth is loud. Fast moves. Big risks. Constant action. But real wealth usually grows quietly. Slowly. Methodically. Almost boring. And today, we're going to talk about something that looks complicated, but is actually one of the most quietly powerful shifts in modern finance. Spot Bitcoin ETFs. You've probably heard the headlines. Bitcoin goes mainstream. Wall Street embraces crypto. Institutions are buying. But very few people actually understand how spot Bitcoin ETFs work or why they matter. So in this video, we're stripping away the noise. No technical jargon. No hype. No price predictions. Just a simple, clear explanation of what a spot Bitcoin ETF really is. How it works behind the scenes. Why it's different from buying Bitcoin directly. And why long-term, quiet investors are paying attention. If you value clarity over excitement, this video is for you. Let's begin. Part 1. What a Bitcoin ETF really is. To understand a spot Bitcoin ETF, we need to start with one simple question. What is an ETF? ETF stands for Exchange Traded Fund. In simple terms, an ETF is a basket that holds assets and trades on a stock exchange like a normal share. Instead of buying each asset yourself, you buy one ETF and it represents ownership of what's inside the basket. For example, a stock market ETF holds many companies. A gold ETF holds physical gold. A bond ETF holds government or corporate bonds. Now let's add Bitcoin to this idea. A spot Bitcoin ETF is a fund that directly holds real Bitcoin and issues shares that trade on a stock exchange. When you buy a share of a spot Bitcoin ETF, you're not buying Bitcoin directly. You're buying a financial instrument backed by actual Bitcoin. That word, spot, is important. Spot means the ETF tracks the current market price of Bitcoin, not future contracts or promises. So the ETF owns real Bitcoin, stored securely, and its share price moves with Bitcoin's price. Simple. But the real value is how this is done. Part 2. How spot Bitcoin ETFs work step by step. Let's walk through the process slowly. Step 1. The ETF provider. A large financial institution creates the ETF. This could be a asset manager, investment firm, or financial giant with regulatory approval. Their job is to manage the fund, follow strict rules, and make sure the ETF tracks Bitcoin accurately. Step 2. Buying real Bitcoin. When money flows into the ETF, the provider buys real Bitcoin from the market. That Bitcoin is then stored with a custodian. A custodian is a specialized institution that holds Bitcoin securely, uses cold storage, follows strict security and auditing standards. The Bitcoin does not sit on an exchange. It's held separately, protected, and verified. Step 3. Creating ETF shares. Once Bitcoin is purchased, the ETF issues shares that represent ownership of that Bitcoin. Each share corresponds to a fraction of Bitcoin. If more investors buy the ETF, more Bitcoin is purchased. More shares are created. If investors sell, shares are reduced. Bitcoin may be sold to balance the fund. This mechanism keeps the ETF price aligned with Bitcoin's actual market value. Step 4. Trading like a stock. Here's the quiet power. The ETF trades on traditional stock exchanges. That means, you can buy it through a normal brokerage account. You don't need a crypto wallet. You don't manage private keys. You don't worry about exchanges collapsing. You just buy and hold. Like any other long-term asset. This is why institutions care. Part 3. Why spot Bitcoin ETFs are different from futures ETFs. Before spot ETFs, Bitcoin ETFs already existed. But they were futures-based ETFs. Here's the difference. Futures Bitcoin ETFs do not hold real Bitcoin. They track Bitcoin using futures contracts. Futures contracts expire and must be rolled over. This creates extra costs and inefficiencies. Over time, futures ETFs can drift away from Bitcoin's real price. Long-term holders lose value quietly. Spot Bitcoin ETFs hold real Bitcoin. Track the actual market price. No futures contracts. No roll costs. No artificial tracking errors. This is why spot ETFs were such a big deal. They're cleaner, simpler, and more honest. For long-term investors, simplicity is strength. Part 4. Why Wall Street Cares. Institutions don't chase hype. They chase liquidity, regulation, risk control. Spot Bitcoin ETFs provide all three. Regulation. Spot ETFs operate under financial regulators, audits, reporting requirements, legal protections. For pension funds, insurance companies, and asset managers, this matters more than returns. Liquidity. ETFs trade all day on major exchanges with tight spreads. Institutions can enter and exit positions without disrupting the market. Risk management. They don't need to store private keys. Train staff on crypto security. Manage wallets. They outsource complexity quietly. This is how capital actually moves. Part 5. How this changes Bitcoin itself. Spot Bitcoin ETFs don't change Bitcoin's code, but they change who can own it. Before, Bitcoin required technical knowledge, self-custody, comfort with volatility and responsibility. Now, Bitcoin becomes an asset inside traditional portfolios, allocated quietly, often in small percentages. This matters because long-term capital behaves differently than retail speculation. It doesn't chase pumps. It doesn't panic on dips. It accumulates slowly. Over time, this changes market structure, volatility, perception. Bitcoin moves from experiment to financial infrastructure. Quietly. Part 6. Spot Bitcoin ETF versus buying Bitcoin directly. This is not about which is better. It's about what fits your strategy. Buying Bitcoin directly, full ownership, self-custody, maximum control, maximum responsibility. Spot Bitcoin ETF, indirect ownership. Custodian holds Bitcoin. Easier access. Fits traditional portfolios. Many long-term investors do both. One for sovereignty. One for structure. Silent wealth isn't about extremes. It's about balance. Part 7. The Quiet Investor's Perspective. Here's the final thought. Spot Bitcoin ETFs are not exciting. They're not designed to make headlines every day. They are designed to reduce friction, increase access, and allow capital to move calmly. This is how wealth systems evolve. Not with noise but with infrastructure. If you understand how spot Bitcoin ETFs work, you don't need to react to headlines. You can observe, think long-term, and move deliberately. That's the silent wealth mindset. If this explanation brought you clarity, take a moment to like the video. Subscribe to Silent Wealth for calm, long-term thinking in a loud financial world. And remember, the smartest money rarely rushes. It waits. It watches. And it moves quietly. See you in the next video.